Hey everybody, it's Tori Summers, realtor with Inspire Texas Realty. I am here with my favorite lender, Brent Johnson, and I just wanted to have a quick conversation and go over some key points that I have buyers ask me about all the time. So specifically, well, here, you can introduce yourself real quick.
Absolutely. So as Tori mentioned, my name is Brent Johnson. I'm with First Centennial Mortgage. I've been in the mortgage lending business for pretty close to 20 years. So it's very rare that a scenario come across my desk that I have not seen before and or solved to. So
Awesome. Okay, so now that we know a little bit about you, I have quite a few buyers call me and talk. They're asking about land loans. So specifically they say, hey, can I get a loan 0% down and I get a mobile home or put something on it? How does that conversation go? I think it's a no is the answer.
Well, it depends. So sometimes there are some 0% options available for land loans, but that is primarily for veterans, and that is through the Texas Veteran Land Board. So they will allow you to buy land with zero money down if you are a veteran. Everywhere else, that's more of a bank product. So your local bank, depending on what town you live in, like Security Bank and Trust and Bernie is really good with that. But those lenders are normally going to require at least a 20% down payment. And then those are normally amortized out over 15, possibly a 20-year period. So those payments are a little bit higher. If you are looking to purchase land to build a house, there are some options to do some of that at the same time. But that's a whole different type of financing. So we would have to sit down and have a conversation about exactly what your time frame is as far as buying the land and building something. But there are some possibilities.
And with those land loans, what is your credit score? Like, what is the baseline? Because most of them are, 620 when you go to buy a house, FHA, conventional. What are you looking at, a higher credit score needed for those types of loans?
Well, for the Texas Veterans Land Board, it would be like a normal VA loan. So usually 620 would be enough to get you there.
Okay.
Anything else, if you're going into it, they're going to expect you to have probably a 660 or 680 credit score, and that will vary depending on the bank. But the general premise behind that is that if you're going to, it's more expensive to build, to buy land and to build than it would be to just buy an existing house.
Wow,
so the expectation is that you have a lot more money for a down payment, and that your credit scores are a little bit higher.
Got it. Okay. Thank you for explaining that.
Yeah.
And that kind of leads us into the importance of credit. So everyone has a credit score, but Brent, what would you say is an ideal credit score to go in to buy a property, buy a house, whatever, FHA, conventional, all the loans?
So credit scores range anywhere from the 500s to the mid 8s. I've never seen one above 850. I've heard they go to 900. I just have never seen one above 850.
It's a myth.
Yeah, exactly. Typically speaking, you'll want at least a 620. And a 620 will allow you to do a conventional loan, and will definitely allow you to do an FHA loan as well as a VA loan. FHA and VA will go below 620. VA technically doesn't have a minimum credit score requirement.
Okay.
However, we run every loan through an automated underwriting system, so that underwriting system has to give an approved finding on a VA loan. But I've seen them get approved down to a 560 credit score before.
That's awesome.
FHA will go down below 585, but if you get below 585, then you have to put 15% down.
Ooh, that's quite a chunk of change.
Right.
So would you say an ideal credit score is in the 700s?
Ideal credit score is 700. The way when you get up into the higher credit scores, your interest rate is determined by your credit score. So the interest rate for somebody that's got a 615 is going to be drastically different than somebody that has a 740. So whatever stage you're at right now in the process of beginning to buy, it's a really good idea to get a lender on the phone that can take a look at your credit report, because there are some things that everyone can do between now and the time they go into contract in order to increase their credit score, because even a 30 or 40 point increase can actually have a drastic difference in your interest rate. And Tori and I have had a few clients where we've done that, where they were new construction and we've managed to raise their score 100 points from the time they went into contract until the time the house was complete, which saved them quite a bit of money in interest.
Yeah, that's a lot of money that they ended up saving just by getting their credit score up. So what are the conversations you would have with someone? Say I come to you and I'm like, hey, I want to buy my first house. What would you say I need to do to financially prepare to buy a house?
So first conversation is, kind of find out what it is they do for a living. Job security, stability is obviously very important. So we'll talk about that a little bit. The second conversation really is around down payment. What do you have saved up? What do you have available? Third conversation is about credit score, because again, if you're not where you need to be, then we have a little bit of time.
Yeah.
And then, figuring out your timeline, what you're comfortable with. What I'm finding lately is interest rates have changed quite a bit, and a lot of folks that are first-time home buyers, they don't know how much the payment's going to be. So they'll go online, they'll go to Zillow, they'll go to realtor.com, they'll set up a property search with Tori for a $400,000 house, thinking that the mortgage payment on that's going to be $1,800. So one of the most important conversations we have is around what their budget is, and then we can kind of reverse engineer a home price based on how much they're comfortable paying.
Gotcha. Okay. So also with that, talking about first-time home buyers, I get questions all the time. What types of programs are out there for first-time home buyers? Is there really a first-time home buyer loan? I know that's a lot. I get that a lot.
Right. Yes and no. So every loan product is available to first-time home buyers.
Okay.
Most loan products are available to people that are not first-time home buyers. So there's only, one or two that are really just for first-time home buyers. Fannie Mae has a product where you can get in with as little as 3% down, where you do have to be a first-time home buyer, because normally Fannie Mae requires 5% down.
Okay.
And then some of the Texas down payment assistance programs have a first-time home buyer requirement.
Okay.
However, they also have programs that don't have a first-time homeowner requirement. So FHA, though, there's no difference in how we underwrite. There's no difference in closing costs or interest rate on whether or not you're a first-time home buyer or if it's your 50th home.
And how do you qualify for the down payment assistance program?
So down payment assistance program, it's done through an agency that's quote unquote backed by the state. The way that works is it's 2, 3, or 4% grant. And there's many different kinds. So I'll give you one example. Is that it's a non-repayable grant, meaning you get that money for free as long as you stay in the house for 3 years. So if you sell it or refinance within a 3-year period, then you have to pay it back. The requirement for that is you have to have at least a 620 credit score, and then they have income caps. So depending on what county you live in and how many people in your household, there's a cap of how much income you can make. And it's for obvious reasons. If you make $300,000 a year, you probably shouldn't be able to get a free down payment assistance program. So it's meant for families that are struggling to save money for a down payment because they don't make a lot. Kendall County, which is Bernie, obviously, has the highest cap in the state, and it's close to $100,000 for a family of 2.
That's awesome. Okay. And what if there's 2 of them and 2 kids?
Then
Does that still apply?
it goes up exponentially. Like it might go up to, and I don't know the number exactly, but it might go up to like 120 or 130.
Okay.
So it does matter on how many people are in the household.
Okay, good to know. Now, can you quickly just run us through the difference between FHA, conventional, and a USDA loan? I think we all kind of understand what a VA loan, which is Veterans Affairs.
Yeah, and I'll just do VA real quick. VA's obviously for retired, separated, and active duty military. The benefits of VA loans are that they'll do 100% financing, and there's no monthly mortgage insurance if you don't put the 20% down.
Okay.
Conventional is typical, streamlined. That's what most people do. It's you have decent credit. The minimum down payment requirement is 5%. If you don't put 20% down, then you have monthly mortgage insurance on conventional. That amount is based on how much you do put down on your credit score. Okay. It falls off after 2 years if you meet the equity requirement, meaning that at that point in time you have 21% equity.
Right.
FHA is a little bit more like what subprime used to be back in the day. They're a lot more lenient on credit score. They're a lot more lenient on collections and payment history. They only require 3.5% down. Awesome. And believe it or not, they typically have a little bit lower interest rate than conventional. That's because it's backed by HUD, which is different than Fannie Mae.
Do you want to explain HUD real quick? Just what it is.
Just the Housing and Urban Development. It's part of the federal government, and that's FHA. That program is administered through the Department of HUD. Fannie Mae is Fannie Mae. It's what they call a GSE, which is a government-sponsored entity, where the government implies that they back them, but Fannie Mae has a lot of money and it's, needed a bailout recently back in 2008, but they have since paid all that back. But they're, for all intents and purposes, a separate entity.
Okay.
And then USDA is a special government program that's designed for lower income areas. So USDA loans are similar to VA, where it's 100% financing. They do have a monthly mortgage insurance amount, but it's minimal compared to FHA and conventional.
Okay.
USDA also has income limits where you can't make
Caps.
over a certain amount.
Okay.
And the mapping of it is kind of goofy. There's no rhyme or reason. It's not like all of South Bexar County is USDA.
Right.
You literally have to plug in a specific address and it will tell
On the
you if
website,
that's
yeah.
USDA eligible.
And also USDA eligible, it's 0% down.
Correct, 100% financing.
Okay.
Correct.
And now, what about if someone wants to buy a property that has a mobile home on it? What is the criteria for that? Because I know mobile homes are a lot harder to finance, and I say mobile homes, I mean property with a mobile home on it. So what is the criteria that maybe the mobile home has to meet specifically?
So manufactured homes are a little bit different. So you've got single wides, you've got double wides. Single wides, it is possible, they just have to be newer.
Okay.
A double wide has to be manufactured after, I believe, 1978.
Okay.
So the basic requirement, and this is going to be the same whether it's VA, FHA, or conventional, is that it's tied down appropriately, and there are certain guidelines that go along with that.
We call that retrofitting.
Retrofitting, correct. And off the top of my head, there's got to be 6 tie downs that are non-corrosive. They have to be tied into 2 feet of concrete in the ground. It gets a little bit complicated. There has to be skirting around it with a vent hole, and axles have to be removed. And the biggest thing is it has to have been converted into real property with the county. So what happens is when you buy a manufactured home off of a manufactured home lot and you have a separate piece of land, that manufactured home at that time is just like a car. It has a title, and then you have a piece of land. So you move the manufactured home onto the land. What you have to do is you have to surrender that title to the state of Texas to convert that over to real property.
They basically have to get married.
Correct. If you don't do that, the financing becomes very difficult because then it's not a piece of real property, it's a lot and a manufactured home.
Got it. Okay. And what if it has been moved more than once? Say from the manufacturer to property A to property B within the first 3 years of the mobile home's life.
Okay, so they can only be moved once.
Okay.
So that's just a general, and the reason for that is if you think about it, the way that they're transported, they shake,
yeah.
all of that. So you get one that's moved 2 or 3 times after it's already installed, wheels put back on, unseparated from the seam, and then moved somewhere else. The quality of the construction, it degrades it. So nobody wants to get in a situation where things have shifted and the structure's not sound.
So when he says it can only be moved once, that just means from the manufacturer to the property.
Correct.
It cannot be moved anywhere else after that. After it's moved to the property, that's it.
Correct.
One and done.
Correct. Now that is typical Fannie Mae, FHA, VA guidelines. That does not mean that there's not a local bank that specializes in those types of loans. So there are loans available. Most lenders that do what I do, we don't, that's not our
it's
lane.
not your specialty.
Right.
Okay. Well, thank you so much. Is there anything else you'd like to add or anything you think is important for maybe first-time home buyers to know, or really anyone that's about to buy a home in this market?
I think for me personally, I think that the first thing is, and this is going to sound self-serving, but talk to a loan officer first. Let's find out where you're at financially. Let's put together a plan. Credit, if you need some credit repair done, that's not something that can happen overnight. So the more time you have to work on that, the more successful you're going to be. And talk to us so that you can understand the payment part. Rates have been very volatile lately. The last thing you want to do is get your heart set on a $400,000 house, come to find out it's $1,500 more than you can afford to pay. So let's just start by having some honest conversations about what it costs, what kind of money you're going to need out of pocket, what are some different options, and if you're what I'll call mortgage ready yet. And if you're not, then what steps do we need to take to get it to where you are mortgage ready?
Affordability. And so also some of those costs I think he's talking about are closing costs.
Correct.
So can you tell me just real quickly what closing costs include?
Right, so when you're buying a house, there's 2 different buckets of costs. First would be the down payment, which we talked about, depending on what kind of loan it is. And the second would be closing costs. So closing costs consist of the appraisal fee, title fees. When you buy a house, your mortgage will include your taxes and insurance. So establishing that initial escrow account would be considered a closing cost. Paying the first month's payment, paying first year's worth of insurance, and then that's really it. But typically speaking, you can expect closing costs to range anywhere from $4,000 to $7,000, depending on the loan size, because they're all based on that.
Right. And so also with that being said, if you have a really good agent like me, you can sometimes get the seller to pay the buyer's closing costs. So that will make your money at closing a lot less.
Correct.
Which
Absolutely.
is a good thing.
Absolutely. And I see Tori do that all the time. And it stopped for a while when the market was crazy, but the last 2 contracts she's had, her buyers actually each got $5,000 worth of free closing costs from the seller. So it's definitely important to choose an agent that's good at negotiating that for you.
And sometimes you can even get a check back if, at closing, if you put down X amount and, the seller is paying so much. I'm not saying it happens all the time, but sometimes it does happen.
Absolutely.
So thank y'all so much for watching this video. And if y'all have any questions, just give me or Brent a call and I will put our information down below. But thank you all and have a good day.
Have an awesome day.